It took Bloom 21 years to deliver its first billion-dollar year in 2022. It took us another 3 years to double our 2022 revenue. Now, we are guiding to double that revenue in just 1 year, having achieved our first $1 billion quarter. Bloom Energy's business is accelerating. We deliver power at AI speed and enable our customers to grow, and demand is compounding. Now, the proven success of our technology, coupled with an increasingly urgent need for efficient, clean, and reliable power, has collapsed the time from first engagement to first order. Because we can book, ship, and convert orders to revenue inside the same fiscal year, that demand shows up in results now, while also adding to and diversifying our backlog. Notably, just this year, several customers who had alternative solutions in place abandoned them and came to Bloom. These customers are now placing longer-term orders, leading to our backlog growing at a faster pace than revenue. Let me repeat, leading to our backlog growing at a faster pace than revenue. Bloom Energy has emerged as a standard for on-site power, as we predicted we would in our third quarter call last year. At that time, we had just announced our first direct hyperscaler customer, Oracle, and delivered them power for a data center within 55 days. NeoClouds, AI labs, and co-location data center operators have validated and approved our power solutions for their AI factories. Our commercial and industrial business continues to grow. Contrast that to AI data centers, where we have become a standard in less than a year. We are clean and reliable and fast and affordable. Let's take a moment to discuss 4 friction points: capital, community, permitting, and speed. But surplus grid capacity is now gone. New data center load now means new infrastructure, heavy capital, long lead time, and ratepayers who will not fund or subsidize capacity for a corporate customer. The faster, cheaper, more predictable path for that customer is islanded on-site power. So we kill that friction with strong financial partners who provide our customers project capital. Brookfield anchors that financing shelf. We formed the partnership last fall at $5 billion. 9 months later, in June, Brookfield expanded its commitment fivefold to $25 billion. One of the largest and most experienced infrastructure investors in the world evaluated our technology, our delivery record, and our pipeline, backed us with $5 billion, watched us execute, and then multiplied that backing by 500%. This quarter, Industrial Development Funding, who has previously funded Bloom deployments, partnered with Oaktree, MUFG Bank, and Morgan Stanley to fund Bloom deployments, cumulatively bringing their total commitment to $2.6 billion. And more financing partners are in the wings. Gigawatt demand needs gigadollars of capital. However, they've also learned they can live next to Bloom Energy servers. No combustion, negligible air pollution compared to turbines and engines, negligible water use. A power server that is aesthetically appealing and runs quieter than air conditioning equipment. Our customers can get air permits with our technology faster than they can with a combustion alternative. And every month saved on permits is a month closer to power availability. Which brings me to speed, because time to power is really time to token revenue. Bloom is increasingly seen as the solution that eliminates the power availability friction point for AI. We think a 4-year backlog is not a trophy. It's a confession of constrained supply. By contrast, Bloom meets the time-critical needs of our customers and delivers power in months. Since the beginning of the year, we have been continuously adding to our American manufacturing capacity in copy-exact increments and will continue to do so ahead of committed orders. And our speed is dependable because we have built a resilient supply chain with broadly available materials by design, multiple qualified suppliers across multiple countries for every critical input, inventory ahead of the ramp, relationships forged over 2 decades. No single supplier and no single country determines our destiny, and every part of our supply chain is prepared to scale with our growth. Capital, community, permitting, speed. Remove all 4 frictions and the market renders its verdict. Supplier of choice. I choose those words deliberately because customers are choosing. Customers who had ordered combustion turbines and reciprocating engines cancel those orders and choose Bloom. Nebius did it this quarter. Existing customers are coming back with expansion opportunities, and the largest infrastructure investors in the world are underwriting our deployments at scale. Customers now come to us late in their development process and ask Bloom to step in as the primary on-site power solution. Bloom Energy is not dependent on one customer or one project. It is multiple customers and multiple projects across every stage of development. Consequently, we have visibility and conviction in our growth trajectory for 2026 and beyond. Will AI investment keep growing at the breakneck pace? Our engagement with customers suggests that the pace of investment will not just continue, but accelerate. We drive costs down every single year. We are experiencing the tailwinds of rapid TAM growth and increasing market share simultaneously. At the same time, we are building a durable advantage by earning the trust of both our customers and the communities.
The demand environment is robust, and we are neither gated by capacity nor our supply chain. The factory improves every week, and cost out is a rhythm here, not a program. Before the results, let me come back to the Brookfield announcement KR discussed. A 5-fold expansion of our strategic partnership as Brookfield increases its framework to finance clean power projects for AI infrastructure. A commitment of that size from one of the world's largest infrastructure investors is significant on its own. And given our shareholder base has grown considerably this past year, let me take a minute to walk through how a Bloom deal works. Every Bloom deal starts with a contract with the end customer, the party that will actually use the power. That contract takes one of 2 basic forms. Either the customer buys the equipment outright, which is a CapEx sale, or they contract for power or capacity without owning the equipment. Since most customers choose to pay over time rather than own, we bring in a financier, an institution like Brookfield that purchases the energy service from Bloom, owns them, and delivers to the end customer under the contract we originated. The IDF partnership that was recently announced is another live example of that model, and it was a meaningful contributor to the quarter. One feature of this model worth understanding, especially for newer investors, is that large campus deliveries are lumpy. 1 or 2 customers could lead our revenue in any given quarter, and the customers rotate as different projects reach their delivery windows. That concentration reflects delivery timing, not the composition of our backlog. The backlog spans multiple hyperscalers, neoclouds, co-location providers, and commercial and industrial operators. And our contracts carry payment security appropriate to the transaction size. Revenue was $1.065 billion, up 166% year over year and 42% sequentially. This was another record quarter for Bloom, and the first time we exceeded $1 billion in quarterly revenue, reflecting accelerating data center deliveries and disciplined execution converting signed demand into revenue. Product revenue was $935 million, up 215% year over year and 43% sequentially, and represented nearly 90% of total revenue in the quarter. Gross margin was 34.3%, up 604 basis points year-over-year. Product gross margin was 37.2%, up 193 basis points sequentially, and up 291 basis points from Q2 of 2025. We deliver value, not a commodity kilowatt. Our customers are paying for time to power and what the solution can do, whether that is following the load profile of an AI campus or being ready for carbon capture. And our pricing reflects that. And on cost, we continue to drive product costs down across material, labor, and overhead. And we are doing that while ramping up our capacity and adding new capabilities. Services margin was 22%, up 977 basis points year-over-year, and our fifth consecutive quarter of double-digit service margins. And we believe we will sustain them there over the long term. Across all of it, we continue to feel good about our full-year gross margin outlook of approximately 34%, which we revised up last quarter. Operating income was $240 million, up 737% year-over-year. An operating margin was 22.5%, an expansion of approximately 1,536 basis points. Adjusted EBITDA was $253 million, approximately 24% of revenue. Non-GAAP diluted EPS was 78 cents, and GAAP diluted EPS was 62 cents. The increase in profitability reflects both higher volume and substantial operating leverage as the business scales. Revenue grew 166%, while operating expenses grew just 48%. We will continue to invest across the business, including G&A and R&D, but we expect operating expense growth to remain well below revenue growth, which should drive continued operating margin expansion. Cash flow from operations was $226 million, an increase of $439.5 million from the same period last year, driven by profitability and favorable working capital performance. Free cash flow was $175 million, and we ended the quarter with $2.7 billion of cash. Generating significant operating cash flow while growing revenue at this current rate truly reflects the strength of the underlying business and the working capital discipline of the team. On the strength of our year-to-date performance, as well as the visibility and confidence we have for our second half, we are raising our full-year revenue outlook to $3.9 to $4.2 billion. At the midpoint, that represents 100% growth over 2025 revenue of just over $2 billion. Our outlook is built bottoms up in two layers. On gross margin, we are holding our full-year margin rate at approximately 34% on a non-GAAP basis. When we have to choose between protecting a point of margin in a given quarter and expediting to deliver an order quickly to a customer who is going to be with us for years, we are going to prioritize the customer and the long-term strategic value of that relationship. Time to power is what our customers value most right now, and we are going to keep delivering against that. On operating income, we are raising our full-year non-GAAP operating income outlook to $800 to $900 million. And at the updated revenue midpoint, this implies an operating margin of approximately 21%. That is a material step up from the $425 to $450 million operating income guide at the beginning of the year, which represented a 14% margin at the midpoint. Full-year non-GAAP diluted EPS outlook is now expected to be $2.55 to $2.85. Finally, a word on how to read our guidance. To conclude, this was a milestone quarter. We exceeded $1 billion in quarterly revenue for the first time, delivered record profitability, generated strong cash flows, and raised our full-year outlook. We are executing with discipline against a demand environment that keeps getting stronger.
How many validated hyperscalers are actively using the technology today, and how many are in the near-term pipeline or backlog?
What I can tell you is the combination of the three things that you spoke about, customers already using it, customers who booked orders and we have shipped units to them for whom the power will be delivered and it's in construction, and customers who have given us definitive agreements. They fall in that category. We are not going to split that up but it is all the major, as you pointed out, it's all the major US hyperscalers and over a dozen of the neo clouds and the ecosystem around it, co-location partners. 9 months ago, we announced our first direct hyperscaler customer and said, we want to enter into this market and do what we did in CNI and become a standard. And I can tell you, I never thought within 9 months we would become the standard. It just speaks to our value proposition in this entire industry. Okay? And that is why this is happening. And this is not reversible.
Is the company's timeline or magnitude of capacity planning accelerating in response to increased demand? And what assurances are given to hyperscalers regarding supply chain reliability and CapEx inflation?
It is very clear to us based on our commercial pipeline and our commercial orders when our customers need their products and when they're ready to turn the units on. And as you understand, very clearly, depending on whose reports you read, somewhere between 30 and 40 gigawatts of new AI data center capacity is going to be turned on in 2027, right? And we have a very sophisticated algorithm that we use to figure out how many of those projects are going to land when. And luckily for us, unlike everybody else, our units are fungible. When they're on a truck, we can redirect them to a different site if we need to. So based on that, we can predict what our capacity needs are going to be such that we never become the bottleneck to the customer. And I can tell you, as we sit here today, we are confident of keeping that promise for everything we have in the order book and everything that we see coming forward. Capacity is not going to be our constraint as we see right now. These are extremely sophisticated consumers and customers. So the amount of diligence that they go through is not just about our product, not just about our performance, not just about our economic value proposition. They want to understand where we are with respect to committed orders, where we are with respect to new orders that can come online. And look, most of them, if you talk to them, are not just signing up for a single transaction. They are signing up with us for the future. They want to be a strategic partner with us for the future. They want to understand, as they share confidentially with us, what their capacity expansion plans are and ask us if we can meet that. And we have to walk through with them under NDA in great detail and convince them that we will be able to scale. That's when we get validated. It's a pretty rigorous process. Our factories, the return on investment is a few months. Okay? So we don't come from the old world. Okay? This is not your industrial age power company. We are relying on the technologies that made consumer electronics and semiconductor devices become better, available in larger quantities to everybody on the planet, and get lower in cost and provide greater value. So let them deal with whatever they're dealing with. From our perspective, for us to expand capacity, the return on investment is going to be a few months, and we'll keep adding capacity as long as the demand is there.
How should the company's expanded $20 billion partnership with Brookfield be viewed in terms of execution timing and the diligence process involved?
The first part is, look, at the end of the day, the financial customers take title of our equipment. When they take title of our equipment, it is not just about can they place it in service. They care about how will it operate through the entire period to be able to deliver. So they go through additional layers of our ability to perform, our ability to be available, and can we upkeep that equipment for the time that is needed based on the financial model that they came up with so they can actually get their returns. So it is two additional layers of detail that they would go through in their diligence, and they go through the same other process that we discussed. And, even in today's world, $20 billion is a lot of money. And again, remember this, they didn't come into it in first step. They put the $5 billion in, they watched how we perform. They watched what we are capable of. They watched the execution. And they spoke to several of our customers, the oldest of them now being more than 15 years our customer, to understand how we perform and how satisfied they are. So it is on the strength of all that they come and invest. As to the timing, look, think of this as a financial shelf. This shelf is now available. The pace at which it will get used up is going to depend on the uptake of those funds. I think I can again say it's very similar to us becoming the standard for AI in less than 9 months. I wouldn't have predicted 9 months ago when they invested $5 billion, we'll come back that quickly for the next $20 billion. And this just speaks to the pace of acceleration, both in AI and in our business.
What is the company's financial exposure to potential project delays, and what contractual protections or alternatives are in place to mitigate risks?
We can tell you when we gave you this guidance and we upward revised it, right? The 2026 revenue guidance is not dependent on any single project. Again, we have a sophisticated algorithm, and we expect certain projects to push out, certain projects to come in, certain projects to just come out of the blue and absorb it in the same year as we described in our script. So we take all that into account when we give the guidance. So, construction projects, as long as construction projects have existed, I'm sure there have been delays. We should bake that in, but that's not going to affect our revenue guidance because we have a sophisticated algorithm to figure that out for the year.
Can the company provide an update on its access to scandium, its usage, and the available supply, particularly regarding dependence on China?
Look, I think we have put out a detailed blog on this topic, and we have filed the 8K. The 3 takeaways for you all as investors to understand are the following. There is enough scandium on the planet that can be recovered economically viably to power the planet. That we have visibility currently based on what we are working for 25 gigawatts of, deployment. And so, and we are not dependent on China. Those are the statements we made.
Why was the free cash flow guidance pulled? And how does the company plan its capital allocation, given its significant cash balance?
So just to level set here, the company has historically included a supplemental presentation that has included some metrics that are not formal guidance, and so we've just really aligned now the presentation to where we truly guide. But to come back to your question on cash, which I think is a relevant one, we see significant conversion from operating income down to free cash flow. As you think about where we started the year with a op income guide of the midpoint of 450 with $200 million of CFOA, we raised that to 675, and now we're looking at 850 at the midpoint. So there's about a $175 million raise versus our prior op income guidance, and we see 100% of that dropping down to CFOA. So you should kind of think about 375 plus as being our new baseline. But as you know, we don't provide formal guidance as part of our earnings release.
How does the company view longer-term AI demand, particularly regarding the balance between power needs for AI training and future inference applications?
So it's both. Look, time to power is super important. Number one, a full stack AI provider that is responsible for everything in the data center financially. The 1 gigawatt data center in one single year, depending on the nature of the AI customer, will deliver between $12 and $24 billion in revenue per year. So you pull in power for them within a month, which is the tall pole, that is $1 to $2 billion of revenue that they would not have had. on a 40 to 50% gross margin and a 20 to 25% net margin. So among the 35 to 40 gigawatts that needs to get deployed next year, take a guess on how much of those projects will get delayed because the power provider is not able to provide power on time. We are the place to go for time to power. Now, as inference comes along, if the transmission distribution infrastructure in the country is having difficulty doing transmission, building highways, imagine how difficult it will be for them to upgrade distribution, which is surface streets. That's where inference power is going to be needed. Bloom is ideally suited for that. You cannot put a gas turbine in the middle of Manhattan. So we see both opportunities as extremely robust for us, not this quarter, not next quarter, for years to come.
How does the company assess the competitive landscape for new power capacity? What is its unique value proposition compared to alternative technologies? And how is its pricing and margin strategy evolving to capture value and displace competitors?
Look, I think given the huge supply-demand gap right now, I think every single technology that can provide power quickly for the next few years is going to have a play. So if engine makers, turbine makers increase their capacity, there's going to be a need for it. If Bloom increases its capacity, there's going to be a need for it. But let's fast forward and think through competitively at a point. If a single customer has to choose between a turbine, an engine, and a fuel cell, okay? The first thing that matters is not LCOE, which is just a absurd construct for on-site power. It is the total cost to tokens, the total cost of power to token revenue. Bloom's ability to provide 800-volt DC power, Bloom's ability to provide reliability without overbuild, Bloom's ability to be able to locate inside a city, outside a city because we don't pollute the air, Bloom's ability to get a permit, okay? None of the other competition, there is not a single commercial vendor today who can provide that total value proposition other than Bloom. What we do then is we don't obsess on the competition, we obsess on the customer. Today, within the data center space, I would say we would be in the very high 90s in terms of our market share. Okay? Competition is a very good thing. Okay? Competition makes us hungrier. Competition makes us run faster. Competition makes us paranoid. And we will thrive in competition. Look, again, we don't think about LCOE, price of electricity, because we're not a utility. We are a strategic partner to our customers, and we deliver value to them. And based on that value, they should be happy buying from us, and they should be happy allowing us to capture value. So it is not just a cents per kilowatt hour story for us. It's about the added benefits we bring to them. It's about an entire solution that we look at. And for us, being able to increase these margins are by capturing value is extremely important. I remember 7 years ago, most of you, the same folks, the analysts, the only thing you worried about is our service losses. And we kept telling you the technology product is going to get robust and you will see us get to the 20% gross margin that we talked to you about. So we just reported this quarter at 22% gross margin. When we went public eight years ago, minus 21% gross margin, negative 21%. This quarter, plus 22%, 43% swing in service margin. Service margin is a financial metric, but the first word in that is service. We're serving our customers. At the end of the day, it's happy customers that matter. So we are not just achieving that financial metric. If you look at 2025, 80% of the orders that we booked were repeat orders from customers who have given us multiple repeat orders. I truly believe that service part of the business and the service revenue and the margins is a big driver to our enterprise value, and more importantly, how we serve our customers in a proper way. And if you combine what I just told you by looking at our backlog, the demand out there, how we fit perfectly to the needs of a future digitized world, unlike previous technology. Look at how we are executing as a team, and then combine that all together to see the trust that we are building within the communities we operate and the companies we serve.
How does the company view the impact of evolving AI models, including commodity or Chinese open source models, on future power demand?
Look, whether it is the Chinese, whether it's the American labs, it just doesn't matter. I would say, as a technology optimist, to me, it's a given that token cost and token efficiency and token's ability to do things are all going to improve. That means the token price point will come down, but the total token usage will go up like crazy because that's Yuan's paradox. And when that happens, you need more power, not less power. So if anything, this is going to accelerate. If anything, whatever we're predicting on AI is an underestimate, not an overestimate.
What is the company's product vision for the next 3 to 4 years, particularly regarding on-site DC power generation, decarbonization, and comprehensive solutions?
Look, I think very clearly, imagine our on-site power. DC is going to be the primary source, whether it's data centers, whether it's anywhere else, whether it's, fleet charging of electric vehicles, whether it is large apartment complexes and microgrids being built for residential complexes. DC is where the world is going to go, right? Predominant. So DC power being generated on site, being able to use the heat to do both the heating and the cooling, and then on top of that, decarbonization, in my view, is going to become super important. And Bloom is able to do carbon capture better than anybody else. Okay? So we are going to be focused on how do we give a comprehensive solution where the fuel is getting utilized at 90+% efficiency, combined efficiency. It is not polluting the air. It's not using water. The same format that a customer gets used to power large data centers is the same format, the same technology that powers your neighborhood store, that powers your neighborhood inference data center. That is the vision, and we want it to be like an appliance that you can plug in and get power.